Hi guys, it's Rob Flux here from Property Developer Network, coming to you for yet another Sunday session. And today's big topic is what tax should I be paying? Some top tips to keep the tax man happy. Now coming into the end of financial year, that's clearly the topic that everyone's talking about is getting tax returns done and preparing for the year ahead. So hopefully some of the tips and tricks that I'm going to be able to give you today are going to set you up for success in the next year, into your next project and the like. Now, I have to have a word of caution clearly, and I should probably put this back up momentarily, and that is I need to say, big disclaimer, I am not an accountant, I am not a financial advisor, I'm not a solicitor, I cannot give you any advice here. Please, this is educational in nature only. So what I'm hoping is I can give you a little bit of insights that you can then go ask your relevant consultants, whether it be your solicitor or your accountant, the right kind of questions. So if you ask the right question, you will get the right answer. Okay, so that's the intent of today. That said, I think I'm going to give you some really good questions to be asking your accountant. So let's have a look at, I guess, the world of tax. Okay, now it's a very, very big topic, okay, and lots of people love to know all about it. But before we go into the one that all the ones that everyone's got in mind, what I want to talk to you about is the fact that property and property development is one of the most over-regulated and overtaxed industries that there actually are. There are almost 40 different hidden taxes that are, I guess, disguised in the property development process that ultimately get handed over to, I guess, the ultimate owner who pays that premium for the property. Now, we talk about housing affordability, and then government regulations come in and have a look at that. So I'm just going to touch on what are some of the hidden taxes that sit in the property development process. We're not going to go into all of them in detail today, but I'm just going to touch on them. So there's stamp duty when we purchase the property initially. Then there's clearly stamp duty when we sell it to the ultimate buyer because they're paying stamp duty a second time. Remembering we are usually creating multiple product. So that's multiple lots of stamp duty, because if we create 6 of something, that's 6 lots of stamp duty on the way out, plus the 1 lot of stamp duty on the way in. There's GST on the sale of the finished product, okay? And obviously there's, I guess, some back and forths that go in regards to that, which we're going to be talking on today. But there's also GST on the construction, the consultants, any inspections, pretty much all of the consultants that we're going to be using in the entire process. GST is added onto every single one of those. Remembering, most of those consultants have to get to and from your property to do inspections and things like that. So there's fuel excises that are put on top of them in order to just get to the property. Then you've got holding costs like land tax that typically is going to be much higher if you're doing this as a investor or developer, because you're going to be having that in some form of corporate entity, so that tends to get taxed at a higher rate. There's finance fees and applications, so things like registering your mortgages and releasing your mortgages and easements and all those sorts of things, they have costs associated that go through to the relevant government authorities. When you are putting all of your civil services, so your water, your sewer, that sort of thing, there's generally authority headworks and connection fees. There's building application and approval fees. There's environmental levies. There's connection to things like Telstra and NBN. There's electrical supplier applications, connections fees. There's multiple council fees. Okay, there's rates. There's contributions or infrastructure fees. There's operational works applications. There's inspection fees. There's plan ceiling fees and the like. There's building inspections, okay? There could, depending upon what you're building and where you're building it, there could be up to 15 different inspections that you need to pay for along the way. Depending upon what you're building, if you're doing large roads or if you're building large sewer or stormwater infrastructure, you may have to put some form of bond onto that. There's then going to be titling and easement fees. And then if you are selling it to somebody who happens to be overseas, then there's Foreign Investment Review Board. That's just the tip of the iceberg, folks. There are way many of these taxes hidden in there. And I'm not going to go through all of them today. What I'm going to go through are all of the common ones that I get the most questions about all the time, okay? Now, There are a multitude of them, but the ones that tend to come up over and over and over is capital gains tax, GST, the margin scheme. What do I do with things like my BAS or business activity statement? Income tax, company tax, should I, what sort of entity should I be doing it in? Excuse me. What sort of entity should I be doing it, etc. Okay, so they're the ones that we're going to try and touch on today, and I'm going to give you some insights into, firstly, what they are and different times that you could or should be using them, and some implications of using them, and potentially some ways to either defer or minimize them wherever humanly possible. Excuse me. Bit of a frog in my throat. All good. Back to it. Now, I'm going to give you 4 questions that you should always be asking yourself when trying to set something like this up. So I'm going to give you the questions up front. Then I'm going to go through all of the machinations of it, of the different definitions and implications and things like that. And then I'm going to try and loop back around again to then ask you the 4 questions and try and play a little bit of a role play and a mud map so it kind of makes sense to you. So the 4 questions are, what is it that we intend to do? So are we investing or are we developing, for example? Okay. How is it that we intend to exit the deal? Are we going to sell some of them? Are we going to sell all of them? Are we going to sell none of them? What entity do we do it in? Okay. Is it going to be an individual, a company, or a trust, for example? And then where are the proceeds or the cash? Where does that end up? Does it get pushed through to you in order for you to actually keep that in your pocket? Do you distribute that between yourself and your family? Does it remain in the entity that you created it, whether that be a company or a trust? Okay, so those 4 questions you want to be thinking about when you go into your conversation with your accountant, when you go into your conversation with your financial planner, etc., so that you know exactly what it is that you're planning to do, because depending upon those answers is going to completely depend on the entity that you do it in, and that is then going to impact, I guess, the taxes that you pay along the way. My humble apologies for the frog in my throat. Okay, so let's have a look. As I said, they're the 4 questions. I'm going to go through this in a little bit out of order for the 4 questions, because it makes it much easier to actually understand. And then what I'll try and do is try and assemble it back together, okay? So common structures that people tend to use. They either do this in their own individual name. They potentially could do this in a company. They could potentially do it in a trust, and that could be either a unit trust or a discretionary trust. Or on very rare circumstances, they can do it in a self-managed super fund. Now, I'm not going to touch on self-managed super funds today because that's a little bit I guess, very detailed and is a topic in and of itself. And I'm not really going to go into which entity you should be doing this in, whether it be individual, company, or trust. But what I am going to do is talk about some of the tax rates and the processes and that sort of thing that might actually apply. So this isn't a which one should you do it in, but rather if you do it in that, what are the implications of that? Okay, so and note, please, again, that each person's individual circumstances are different. What you're trying to achieve and what the next person might be trying to achieve for the exact same project might be different. So make sure you do seek your appropriate expert advice from your accountant and your asset protection solicitor when you're trying to determine what structures you're going to do it in. So let's start at the beginning, okay? When you're going to do your very first project, one of the most common things that I hear is that their accountant has told them, why don't you just do the first one in your own personal name? Now, if you've received that advice, then, or whether you've received that advice or if you've just done that anyway, then any profits that you would make would be deemed to be income tax, okay? So this is nothing about your asset protection and should you have done it in your name, but rather when you make the money, what tax rate actually would apply. Now, income tax rates in Australia have 5 different thresholds, and depending upon how much money you make, you jump up a threshold, pay a little bit more tax, jump up a threshold, pay a little bit more tax, okay? So with those 5 thresholds, if you are earning less than $18,200, you pay 0 tax, okay? Very handy. If you're paying between $18,200 and $45,000, and that has just gone up this year, you only pay 19 cents in the dollar for anything in that bracket. When you go over 45,000 and up to 120,000, you now pay for 32.5 cents in the dollar. If you go above 120,000 up to 180K, you're going to be paying 37 cents in the dollar. And if you're above 180K and over, you're paying 45 cents in the dollar. Now, the Australian average wage is around the 80K mark. So the majority of us are going to be in the 32.5 cents category, or if we're lucky to be a little bit above average, we might be in the 37 cents in the dollar category. So if you think of that as that's what your base wage is today with your day job, and then you go do a property development on top of that, then the likelihood is that, or not the likelihood, that income from the property development adds on top of the wage and is likely to bump you up at least one tax bracket and potentially even two, meaning that the profit that you make if you do it in your own name is likely to be taxed at really high rates. Okay, so I guess irrespective of your asset protection position, your I guess the amount of money that you actually get to keep is really going to be impacted. So my guidance is go talk to your accountant and ask them whether or not you should actually be doing this in your individual tax name. Now, whilst I can't give you advice, if your accountant tells you that you should do it in your own personal name for the first one because it's so low risk, my humble guidance, or humble opinion, I should say, would be go seek another accountant, because they're not really looking after you either for an asset protection purpose, nor are they looking after you for minimizing your tax purposes. Okay, they're just making it nice and simple and easy for them to actually go through the process. So if you're not going to do it in your individual name, then the most logical thing next would be do it in some form of an entity. So perhaps a company, for example. So if we have a look at a company, then companies have two different scales to them, okay? So there is what is called a base entity, okay? So this is for smaller companies that earn less than $25 million a year. So for the majority of us, that's going to be us, okay? So where that's the case, where we're earning less than 25 million, then the tax rate that we pay over the last couple of years has been on a progressive change to reduce the amount of tax payable. It's one of the things that the current government has implemented to try and stimulate the economy, get more jobs going. So they've been slowly ratcheting down the tax rate in those companies. And so for the majority of us, for the 20 to 21 year, which is just finished, that would be 26 cents in the dollar. And for the year coming up, 21 to 22 financial year, that would be 25 cents in the dollar, okay? And that's not intended to ratchet any lower than that. Now, if you were earning more than 25 million, you'd actually be at 30 cents in the dollar. So, you know, for those smaller businesses, which is about, I'm going to say 85% of all the businesses in Australia, less than $25 million turnover, that's actually a good thing to try and stimulate them. So 25 cents in the dollar in a company is way, way, way different to the most likely, the Australian average, we're at 32.5 cents of the dollar, even as a baseline. So if you do something in a company, then instantly your tax is a much lower threshold than if you did it in your own personal name, in all likelihood, okay? Now, I'm not saying that's the right place to do it. I'm just talking to you about pure numbers, okay? Now, with a company, okay, when the taxes are actually due, so company tax is actually due the same as us, end of financial year, okay? So if you're running a project, let's just say you set up a brand spanking new entity today, you go and run your project, and your project might take, let's just say, a year to run, and it finishes just before the end of financial year. So you'd be lodging your, I guess, your end of company return right at the end of the financial year. And so if we did it today, we just finished today, then I've got about a week until end of financial year, and I'd have to lodge my tax return, plus a few months that the government allows us to, I guess, get our affairs into order, okay? So typically they'll allow us, if we're lodging ourselves, they'll allow us 3 months to do that. If we're going through an accountant, they'll allow us 9 months to do that. So project finishes today, end of financial year is next week. We've got 9 months after that, okay? Now, if we take that a logical step further, well, if the project didn't finish today, let's just say it finished in a fortnight's time, which happens to be in a new financial year, then the end of tax return is not due until the next financial year, so an entire year later. So it allows us to potentially defer our tax by an entire year just because of the fact that our project finished, I guess, at the start of a financial year versus, the end of a financial year. So we want to be very careful as to when it's due, okay? Now, the moment we do our very first tax return, the government says, hey, you just earned a lot of money. If you ever want to do any business with us ever again, we're going to predict that you're always going to earn a lot of money, okay? And therefore, we don't want to wait an entire year for tax anymore. We're going to put you on installments because we believe that you're always going to be earning that money. And they put you onto what is called PAYG, pay as you go, which means that whilst you had the benefit of this big, long deferral up until when you did the first lodgement, after that, they say every single quarter, you're going to pay tax in advance. Thank you, my friend. I'd really appreciate that money right now because I think you're going to earn it and I just want to take it. So PAYG, pay as you go, would be predicting that you're going to keep earning that. So if you run your project, then you do your end of financial year return, then you close down your entity, that PAYG obligation disappears because the entity doesn't exist anymore. There's an opportunity now to potentially start a new entity for the new project, get another long deferral till when your tax return is due. So good way where you're, able to push out when your tax is due. Now, this is not avoiding tax, my friends. This is all about deferring of tax. And while you defer your tax, that means you've got access to 100% of the funds. If you've got access to 100% of the funds, that means that you're going to be able to utilize that and potentially amplify your returns much, much faster than anybody else, okay? So really good if you can do it, okay? Now, so that said, okay, we've talked about individual tax returns and company tax returns, okay? And what sort of tax rates that they would actually be on. Now let's talk about different tax types, okay? So now I've heard many, many people say, when I do my first project, I'm going to do this and get capital gains tax. So let's talk about capital gains tax. Capital gains tax is intended for when you purchase an asset and you hold that asset for a long period of time and then sell that asset for a profit. So it's intended for, a long-term hold, okay? So now personal assets like your home, your car, furniture, things like that, they are exempt, but pretty much everything else is actually included, okay? So whether you're buying shares, whether you're buying property, so CGT applies for that long-term hold type approach, okay? So if you're an Australian resident, that also includes property that you own overseas, okay? So be very careful that, capital gains tax can apply pretty much anywhere in the world if you're an Australian resident, okay? Now, the other thing with capital gains tax is it's basically what they do is they say, well, you bought it at this price and you sold it for this price, and so the difference between them is your capital gain. Now, depending upon the entity that you own that in, there may or may not be an opportunity to get a discount on that uplift. So let's just say you bought something for $500,000, you sold it for $1 million, there's a $500,000 uplift. Then depending upon the entity that you own that in, you may be able to claim only 50% of that. So 50% of that would be a $250K uplift. Now, if that entity happened to be in your own personal name, then that 250K would add to your income tax. So where I said before, your thresholds, all of a sudden you've just jumped up to the maximum threshold and you're paying maximum tax at an insane rate. If you happen to do that in a company, then you can't claim the 50% discount. And so the uplift, whilst you can't get the discount, the uplift is taxed at a lower rate. So you've got to start to think about, well, which entity do I want to do it in? Do I want to be paying pay a much higher tax rate on a smaller amount because I've got the discount, or do I want to pay a lower tax rate on a higher amount? So you've got to start to predict what that's going to be, what that's going to look like, how long you're going to hold it for, what you think the uplift is going to be, lots of implications and machinations of how that can actually apply. There's also the ability to potentially own that in other entities such as trusts, which then do get the capital gains tax discount. So that's when capital gains tax does apply, okay? So the next thing would be, well, what about GST? When does that apply, okay? So GST would apply in certain situations where you're actually buying and selling land, or what they call the government has a definition of what property is. So they call property being land and buildings, or interest in land. So it means you don't actually have to own it. Rights over land, again, you don't have to own it, or a license to occupy land. Okay, so you can potentially be paying GST even when you don't own the property. So be very, very careful with that. Okay, so they define that the supply as a sale, a lease, a transfer of rights or similar dealings in property. That's how they actually define it. Okay, now what they say is if that entity was trading in such a way, and I'm going to loosely say entity here at this point in time because it'll loop around in a moment. If that entity earns more than $75,000 a year, then GST would apply. Now, as we are trading in property, then the likelihood of a property being less than 75K is pretty low. So almost certainly, if GST does apply to us, we are going to hit that threshold, okay? The question is not if we're going to hit it. The question is, when are we going to hit it? And the only time we are obliged to register for GST is the moment we have certainty that we're going to do that. So whilst we're running a project, our intention is that we're going to make money, but unless and until we actually have a sale of contract, we have no certainty that we'll have money, okay? And so there's an opportunity that you don't necessarily register for GST day one. Now, there are benefits to registering early. There's benefits to deferring that, and I'll touch on a little bit later on, okay? Now, whether you have to register for GST or whether GST qualifies depends on whether or not you are deemed to be running an enterprise, okay? So an enterprise is the government's way of basically saying, we think that you are running a business. So whether you are running a business or not, whether you're running a company, doing it in a trust, doing it in your personal name or otherwise, the government looks at you and says, we think that that is a business. And so, for example, if you're buying land to subdivide with the intention to sell for profit, or if you're building new residents with the intention to sell them, the government deems that your intention is to profit from that process. Now, want to be very clear here, the ATO has a very specific, repeated statement on their website. Even a one-off property transaction may be deemed an enterprise, which means that if your intention was to develop for profit, then they are going to deem that to be an enterprise. And so GST is almost certainly going to apply rather than CGT. Now, I want to be clear here, what was your intention, okay? So if you think that your intention is slightly different, you want to make sure that you capture that way at the start of that and have some sort of audit trail to document what your intention is. My intention is to hold it long-term. My intention is to trade it for development purposes, okay? Make sure you have the appropriate chat with your accountant and say, look, this is what I want to do, and then put an audit trail into the accountant to say, this is how we're actually going to capture my intention, okay? Because despite our best intentions, sometimes circumstances change. So it's always good to actually have your intention captured and audited so that at some point later on, if you need to change because circumstances have forced you to change, then you can actually say, well, this is what we meant to do. Circumstances changed. I still want to claim that particular path. Okay, so that is very much a thing that you need to do. Now, assuming that you have got to the point where GST actually does apply, as I said, it's about the 75K turnover within your business. Now, when you have that certainty, okay, then there's a couple of things that you need to do. Okay, so you need to register for GST. That's the first thing. You need to work out whether the sale of what it is that you are selling, whether or not that is subject to GST. Now, some properties GST will apply, some properties it won't, and I'll touch on some of those in a sec. You've got to make sure that you issue tax invoices for any of your taxable sales, okay? You need to obtain tax invoices for any of your consultants that have given you anything, and a tax invoice needs to specifically be a tax invoice that actually declares the GST amounts on there. You can then do well, I got charged X amount of GST from my consultants and my builders and my contractors and all that sort of thing. And I had to pay X amount of GST on the sale of the property. So you do this unders and overs and you go, well, this is how much I paid out. This is how much I should be able to claim back in. And you lodge what is called a business activity statement, or a BAS. And that does the true up to say, well, this is how much you owed. This is how much you've already paid by paying GST to other people. We're just going to say that you only need to pay for the difference. Okay, so that's what your BAS does. Okay, now BASs are one of those things that once you actually start registering, once you've actually registered for GST, you have to do them on a regular basis. Now, I touched on would the property be, I guess, GST included, and not every single property comes into that category. So if it's land, GST does apply, okay? If it is land and buildings and they are new buildings, so brand new townhouse, brand new house, for example, brand new apartment complex, GST would apply. If they are substantially renovated, and there's a definition on the ATO website as to what substantially renovated is, so it's not giving it I guess a spruce up and a lick of paint, but rather, you know, some substantial works and extensions and structural works and that sort of thing. If you do a substantial renovation, they're going to be deeming the property to be largely new, and therefore GST would apply. If you have interest in land or rights over land or a license to occupy land, i.e. you don't own it, but you have the ability to control it, then GST may also apply, okay? Now, GST does not apply where there are existing homes, okay? So a second-hand home, a residential home that has already been in existence, people have already lived in it, and is now second-hand. It does not apply in that particular instance. So then sometimes, depending upon the project that you're doing, if you're knocking everything down and building everything brand new, GST is going to apply on absolutely everything. If you are keeping the existing home and you're able to build around it or subdivide out the back or do something like that, then a portion of what you sell will be GST inclusive and a portion of what you sell will be GST exclusive, which means that you're going to have to do some sort of true up to work out all of those consultants you paid, how much of the GST that you paid out already is claimable onto those entities, okay? Now, when you're lodging your BAS preparation, okay, there's a whole bunch of things that you need to start to consider. And that is, as I said, you've got to lodge these on a regular basis. Now, you must lodge them quarterly once you have actually gotten to the point where you are registered for GST. And when you do it quarterly, it's the 14th day of the month, okay? So every quarter on the 14th day of the month, you must lodge your your BAS return. Sorry, tongue-tied there, folks. You have an option, if you want to do this, that you could actually do this on a monthly basis. Now, if you do it on a monthly basis, the date changes. It will be the 7th day of the month in order to do that. Now, why would you do it on a monthly basis? Well, if the size of the project is large enough and the amount of credits that you're actually paying out to your consultants and your builders and all those sorts of things are large enough, you may want the cash flow of being able to claim those GST imputation credits back much faster. So it's a little bit more of a accounting overhead, but it improves your cash flow position massively. If you've got a much smaller project, then the overheads in actually doing it monthly may not actually justify the cash flow benefits of that. My humble apologies, folks. A little bit of a frog in my throat. Now, as I said, your BAS is due every single quarter, okay? So if you have, as you're running your project, this is where it gets really interesting, as you're running your project and you do not have sales locked in, then you do not have absolute certainty of your income, okay? Now, because you don't have absolute certainty of your income, there is the potential that you can say, well, I don't need to register for GST just yet. But the moment you have a single sale, whether it be a pre-sale of the plan, whether it be a sale of the finished product, at that point, you absolutely have certainty of your income. And because you have certainty of your income, you have to go, is that over 75K? Likelihood is probably yes, given that it's very hard to get property underneath 75K in Australia anymore. So almost certainly you're going to have to register for BAS. So there's a period of time where you may be able to defer. I say may, and then there's a period of time where you must lodge. Okay, now but you can also optionally choose to do it early if you want to improve your cash flow along the way. So either way, at the moment you are registered, you must do a quarterly basis on your BAS, okay? So mandatory that it's quarterly once you're registered, optionally that it's monthly if you really want to. Okay, so the question then comes down to, well, I've gone through CGT and I've gone through GST, which of those two should I actually be paying? Well, as I touched on before, the ATO, it all comes down to intent, okay? So your intent right at the start, are you going to be an investor, as in long-term hold of that asset, or are you intending to be an enterprise? Okay, are you running a business where you're actually going to turn that over and your intention is to profit? Okay, now the ATO gives some very specific examples, and they also very categorically say that even a one-off property transaction may be deemed an enterprise. And so if your intention is up front to go and, manufacture your profit and flip it, almost certainly you're going to trigger that. So as I said, intent, make sure you capture your intent, that you talk to your accountant, make sure that that your intent and their advice are in alignment, and then get some sort of audit trail to make sure that that would actually apply. But almost certainly, folks, almost certainly, if you are in property development, then it is likely that GST will apply. The exception to that would be if your intention is to manufacture that profit and not sell, and instead hold on to it for the long term, in which case you genuinely are going to be an investor, but you just happen to be manufacturing your profits a little bit early. So that might be a genuine case, a genuine use case of you being an investor. Now, when that happens, the ATO says, well, we understand that that might be the case, but we want you to prove that your intention is to be an investor. We want you to hold that for a long period of time. Now, don't quote me on this exact timeline. It's either 5 or 6 years. If you sell the property earlier than that, they're going to go, well, we told you you were running an enterprise. But if you hold it for greater than that period of time, they go, yep, fair enough. You said you're an investor. You really are an investor. We're happy with your answer on that. Okay. So make sure you check with your accountant on all of those. Now, let's just assume for a moment, because in the majority of instances, GST is likely to apply. Let's just assume now that GST has applied, in which case you are going to run a successful project, because that's what we all want to do. And at the end, you're going to start to sell your properties, your profits. And at this point, a thing called GST withholding tax starts to kick in, okay? Now, withholding tax is the ATO's way of saying, well, what we want to do is get access to that tax straight away. We don't want to wait for your BAS anymore. Now, there's a whole backstory as to how this actually came into effect. But basically, there were a lot of unscrupulous property developers who would settle on a property, get all the cash, and they would shut down their entity before paying their BAS. And then a couple of months later, they'd create a brand new entity, open that up, and it was called phoenixing, okay? So the ATO went, well, we don't want any of that anymore. So the ATO never got their GST at all. So ATO said, we don't want any of that anymore. What we're going to do is we're going to force the GST to be paid to us in advance, and we're going to make you overpay because we're going to estimate on the high side, and then you're going to have to come back to us and justify why you should actually get the balance back. Okay, so they're withholding it from you at the point of settlement. So that's the backstory. Now that came into effect in about 3 years ago now, I guess 2018 from memory. Now it doesn't change what your obligation is with regards to how much tax you pay, but rather it just changes the order in which it was paid. So now it goes straight to the ATO, then you go do your BAS, then you get your credits back on that, okay? Now, how much money does the ATO hold? Well, it depends on what it was that you were selling and whether or not you can apply a thing called the margin scheme, and I'm going to talk to the margin scheme in a couple of moments, okay? So if you can't claim the margin scheme, and if you're just selling as GST, then they will take 1/11 of the contract price, 1/11, okay? So approximately 10%, okay? Now, that's not exact math, but it's approximately 10%. If you are able to claim the margin scheme, they're going to take approximately 7% of the contract price, okay? Now, again, both, excuse me, both of those figures are almost certainly over and above what your actual obligation is. So the ATO will be in credit and you'll have to go and claim those credits back, okay? And again, you would claim those back at, I guess, GST time. Now, sorry, at BAS time, I should say, my humble apologies. Now, again, which properties would that actually apply to? New residential properties, okay? Substantially renovated properties and potential and subdivided land, okay? That's what that's actually going to apply for. It wouldn't apply to commercial properties that are what they call going concerns and things like that, okay? Now, so I touched on a thing called the margin scheme and the fact that that withholding tax might be a little bit different. So what is the margin scheme? It's this mythical thing that we all know we're going to get charged less tax if we can actually do this thing. So let's give you an example. So the margin is basically the margin between what you paid for it and what you sold it for, okay? So that margin in between, as opposed to just selling the property in its entirety. So let's just give you, I guess, a hypothetical example. Let's just say you buy a block of land for $150,000. You make $150,000 worth of improvement. So your total cost is about $300,000 and you sell that property for $400,000, okay? So nice, simple, easy equation. Now, the margin on that would be the difference between what you bought it for, which was $150,000, and what you sold it for, which was $400,000. So that margin would be $250,000, okay? So you're not paying GST on the $400,000, which you would if you couldn't claim the margin scheme, but rather you're paying it on the margin between, being the $250,000. Now, because you had $150,000 worth of improvements on there, chances are most of those improvements you were paying consultants that charged you GST, so you're going to have some imputation credits that you would have already prepaid in advance that you may be able to claim back to discount what you would actually have to pay on that margin. So your GST would have been, I guess, on the margin at $250,000 and 1/11 of that, less any imputation credits that you may have paid on that $150,000. Okay, nice, simple, easy concept. But hard to actually implement in practice, okay? Okay, so next one would be, there are other taxes such as rates, okay? Now, rates are going to be very different to in every single council, but basically they have a couple of very basic methodologies that they apply to it, and the valuation methods slightly change. Is it based on the unimproved capital value of the property, or is it based on the improved capital value of the property? Okay, either way, the entity that you do it in, generally, if you're trying to do that in some form of corporate entity, whether it be a company or a trust, generally is a slightly higher rate than it is for your doing it in your own individual name. So when you're trying to start to assess which entity I'm starting to do it in, you've got to go, well, there's unders and overs. So I might pay less tax in one category by doing it this way, but I'll pay more tax over here for doing the exact same thing. Okay, so those unders and overs are quite important to actually consider. Now, rates are used by councils to do things like building roads and bridges and parks and libraries and all those sorts of things. Okay, so rates are one of those things that, it's a fair service that they actually provide. So I'm okay with paying it. The next one, land tax. I'm not so happy with paying that one. Okay, so land tax is really, really, really complicated. Now, it is very different in every single state. It is generally how it works at a very high level is that there are a series of thresholds as to the value of the land, and based on the value of the land and based on the entity in which you've purchased it in would determine what land tax rate that you would actually apply. Now, some states are really good and really flexible. They have these really nice thresholds where they say if you have it well below this number, it's going to be no tax at all. And some have really low thresholds, which means you're going to trigger it almost all the time. Some of them are not very nice with regards to trying to do that in some form of corporate entity. And they deem that that's a fair opportunity to charge extra, because clearly if you're doing it in a corporate entity, you must be rich, you must be loaded, therefore we're going to take a little bit more tax off of you. Okay, now there are different governing bodies around the nation depending upon the state you're in, but largely they go by different names, but largely it's the Office of State Revenue in each office. So for example, in New South Wales, Office of State Revenue, or in Victoria, it's called the State Revenue Office of Victoria, okay? In South Australia, it's called Revenue SA. So either way, it's the Office of State Revenue where they're collecting your taxes. Now, when land tax is actually assessed, the concept being is, do you have the land on a particular date of the year? So on this one specific date, if you own the property, land tax would apply, but if you don't own it on that date, land tax does not apply. So the timing of your project and the timing of settlement could massively impact the amount of tax that you're actually paying. Now, so that one date you want to be careful of changes in every single state. So in New South Wales and Victoria, that magic date is the 31st of December. So if you own it on that day, land tax does apply. If you don't own it on that day, land tax does not apply. In Queensland, South Australia, and Western Australia, that magic date is the 30th of June, okay? And if you're in the ACT and Tasmania, the magic date is the 1st of July. So if you can time the settlement of your project to be just after those dates with any way, shape, or form, you may save massively with regards to the amount of land tax that you actually pay. Now, if you happen to be in the Northern Territory, no land tax, lucky you, okay? Now, irrespective of whether you're going to do it in your own personal name, irrespective if you're doing it in a company or a trust, all of those things, it's really important that you actually keep your records for all of your transactions. So your contracts, your invoices, everything along those lines, okay? Now, the ATO has a requirement that you must keep those records for at least 5 years, okay? So please, 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 please make sure that you keep them. My guidance would be to scan them electronically, put them onto some sort of cloud account, have that replicated off-site so that even if your house burns down, you've got copies of those somewhere and you can always get access to them. Really important that you can actually do that and justify any of your assessment calculations, okay? So I said right at the start, so let's wrap this up. What I said at the start was 4 steps to actually work out and 4 questions to actually ask yourself. So what we do. So that's the first question. Are we investing or are we developing? And as we touched on, if you're investing, capital gains tax. If you're developing, you're going to be deemed to be running an enterprise, it would be GST. So that's a pretty clear, easy concept to understand which tax would actually apply. How we intend to exit the deal? Well, are we going to sell all of them, some of them, or none of them? Well, that again comes back to what are we doing? So if our intention is to keep some and keep them long term, perhaps we were an investor after all. Okay, again, it comes down to intent. So would capital gains tax apply or would GST apply? Remember, when we exit, if the ATO wants us to keep it for a certain period of time, just to prove that our intention was really honourable. If we get past that threshold, and again, I can't remember if it's exactly 5 years or 6 years, but let's just say 6 for the purposes of this conversation. If you get past the 6th year, they'll go, okay, fair enough, you were an investor, capital gains tax. If you sell it under less than that time, they go, well, we thought you were a developer and you've just proved it to us. So therefore it's going to be GST. Okay, so really important that you make sure that you keep all your records so that you can, one, prove your intent, which you may be able to justify. And the second one would be, I guess, make sure you keep those records so you can go back and retrospectively claim any imputation credits that you may have to if you get forced to do it. So the third question, what entity do we do it in? Well, this is really important that you talk to your solicitor for asset protection advice and also your accountant for your tax minimization advice, because if you do it in an individual, then you're very commercially exposed from an asset protection point of view, and your tax position might be very, very different. If you do it in a company, your tax might be really, really low, but if your intention is to keep it, then you won't be able to get things like your capital gains tax discount if you intend to be an investor. And if you want to do a trust, then that's a little bit of a extra expense if you don't need to, because you're always flipping it, but it does give you a whole bunch of extra flexibility with regards to being able to claim your capital gains tax discounts and the like. So really lots of moving parts with all of those things as to which entity you actually want to do it in, and your best conversation is with your accountant for tax reasons and your solicitor for asset protection reasons, okay? Almost guaranteed they're going to give you different advice because they're trying to protect you in a different way. So make sure that you get the two of them together in the same room, ask the hard questions and get them to come up with a compromise that works for you, okay? Fourth question is, where are the proceeds or the cash going to end up? Okay, so and I touched on the different tax thresholds before. If the proceeds are going to stay in a company, you're likely only going to be paying that company tax at 26 cents in the dollar. That company can reinvest that and be able to repurpose that much more efficiently than if you push it down into your own personal name and it goes up into a really high tax bracket and you're going to be paying really, really high rates. Okay, so and then is there an ability to distribute the money through a trust to many, many people and smooth out that tax over I guess a number of different people. So remembering that there are two individual tax thresholds which are below that company threshold, and so if you can distribute some cash through to those people, then you may be able to reduce your income as well. So there's a couple of different permutations in what it is that you can actually do. So again, those 4 questions in summary: what are we going to do? How do we intend to exit the deal? What entity do we intend to do it in? And where are the proceeds actually going to end up at the end of the deal? So if you can ask yourself those 4 questions when you go in and talk to your relevant accountant and or solicitor, your relevant specialists, then they will be able to give you the best advice in how and what you can actually do, okay? So some other hot tips that's going to help you out massively, okay? Consider your exit strategy before purchase. I cannot stress this enough, okay? If your intention for your exit strategy changes, so it can be very, very expensive. So is it going to be flipping the stock? Is it going to be keeping all of the stock? Is it going to flip some, keep some, okay? Depending upon which one that is, the entity that you put it in could cost you massively to change things like stamp duties, and it might trigger capital gains tax and all sorts of things if you need to change along the way. So please think about that right up front and make sure that you give your accountant that really good, clear advice. I know exactly what I want. Or, hey, I'm not sure, I need some flexibility. I may have to pay a little bit more for a more expensive structure that gives me that flexibility, that doesn't trigger all of the additional stamp duties and capital gains taxes and all that sort of thing later on if I need to change entities halfway along the way. Next hot tip: get good legal and accounting advice prior to purchase, please. This is essential. I cannot stress this often enough, okay? they are I guess the two most expensive people in your team, but they are the people that are going to save you the most amount of money in your team. And they're the ones, like an insurance policy, are going to protect your ass if something goes wrong. So please, please, please pay for good advice, not just cheap advice, okay? And along those lines, if your accountant says to do your first deal in your own name, consider getting another accountant, because that's one of those cheap ones that I'm talking about, okay? They're not really looking after you for asset protection reasons, and they're not really looking after you for tax minimization reasons. And so they're exposing you quite high and putting you into a very high tax bracket, which just doesn't seem to make sense, okay? Use the margin scheme at every opportunity. There's quite a bit to learn about the margin scheme, guys. Go and find out your obligations. Go and find out, excuse me, go and talk to your accountant. Make sure you actually understand what you need to do to document that appropriately. Make sure that that is in all of the contracts and worded in an appropriate way to make sure that you can actually claim that, okay? And assess your need for cash flow during the deal. This is the last tip. Do you need to register for GST early? In which case you can claim the imputation credits you've paid back to your consultants early. You're going to get some of that back from the ATO, even though you've not generated any revenue yet. So you have the ability to do that early if you want to, and you even have the ability to do that monthly if you really, really, really need good cash flow, okay? Some other good habits, okay? I said keep records for 5 years. Make sure you have some really good document naming conventions, okay? If you have some good conventions, that's going to help you in being able to find files easily, you know, find all your records and which consultant you did at what point in time, okay? And then lastly, make sure you're using a really good online accounting system, whether it be Xero, MyOb, that sort of thing. You know, there's a number of different ones out there. Get that to link into your bank platform. The bank platforms then going to capture every single transaction that you do. You're going to be able to account for that. You're going to be able to upload your invoices. You're going to validate your transactions. It's going to create a nice, easy process for your BAS processes. It's going to make it nice and easy for your accountant to do their work. And make sure you give your accountant access to your file. So they're my tips, guys. Now that said, I'm going to take some questions from the crowd in a moment. But until then, just give you a little bit of a reminder that we do these Sunday sessions almost weekly. We have a massive back catalogue of those that we put onto our YouTube channel. So if you've got anything that you want to know, go to YouTube, search for Property Developer Network, or do that little short URL there, propdev.info/YouTube, and that will take you straight there. And you can go and watch the back catalogue of everything that we've done to date. Also letting you know that we run a whole bunch of Facebook groups. So there's Property Developer Network and also the development site Deal Hub. And we also, in case you weren't aware, we run monthly networking groups in 3 states. That's Brisbane, Sydney, and Melbourne. I don't have a slide on that, but make sure you Google Property Developer Network, go to our site and just follow your nose and you'll be able to find those events. So what I'm going to do now, folks, is I'm going to go over to Facebook. I'm going to see what questions we've got and hopefully talk about all things tax. So let's see who we've got. Okay. So Carol said a scotch will get rid of that cough. Thank you, Carol. Yes, it absolutely would. Luke's on there going, boom. Hey, mate, how are you? Buy. Luke is always buying around the place. So anyone looking for a buyer's agent, Luke Moroney is your man. Ruth says, Rob, is a transcript available for today's talk? I find that completely useful so I can think carefully through each of your detailed points. Thank you, Ruth. The system generates a transcript and attaches it to the video, but there's not one that we can actually detach from that, Ruth. So unfortunately, no is the answer, but yes is the answer all at the same time. So you can see on the video, it's actually putting words underneath me. It's doing that auto-magically. That's not me doing that. I can't type that fast nor that accurately, but unfortunately, that's the question. So Robert's got a A raining umbrella. I'm not quite sure what that's referring to. Okay. Sadiq says 6 years from the date you signed the contract for the parcel of land. I think that's what he's referring to. And then Karen says 5. So as I said, I wasn't 100% sure. Is it 6 or is it 5? But what they're talking about is the requirement for are you changing from capital gains tax to GST and how long you actually hold the property for. So it's one of those two, folks. What I'll try and do later on is I'll try and just Google it and put the answer into the chat so that there is no argument on that. Couple of people still going back and forth on that exact same thing. So clearly that's an issue I will resolve, folks. So stay tuned on that one. Okay. Peter says, fantastic coverage of tax issues. Thanks, Pete. Appreciate that, mate. Long-time listener. Haven't seen you for a while. Christy says, amazing session, Rob. Thank you very much. You're more than welcome. Loving the new video setup, very clear. Thank you, Felicity. I love that as well. And lots of other people saying fantastic. Thank you, folks. I really appreciate that. Helen says, hi, Rob. Thanks for great info. A quick question, exit strategy. Are we better off to sell all blocks instead of keeping some to avoid capital gains tax? Oh, Helen, want to be really clear. I can't give you advice. I can give you my opinion, okay? I don't know your individual circumstance, and so I don't know what is appropriate for you individually. What I could say, though, is that if you have the ability to keep, so you can afford the serviceability, it's generating appropriate cash flow, that sort of thing, then keeping stock is the ultimate goal. Okay, what we really want to do is we want to be generating passive income, because that passive income then ends up being what replaces our wage, which sets us financially free. So wherever humanly possible, we want to be able to keep. There's some advantages in that if we don't sell, then we don't realize our profit. And if we don't realize our profit, we have effectively deferred our tax. Now, I say defer, we haven't avoided. At some point in the future, we may sell that property, in which case the tax would be due at that point in time, okay? And so if we can avoid selling, we avoid paying a lot of the tax that we've talked about today. Sorry, defer, not avoid. And so, which means that the profits stay in the deal, which means that the long-term buy and hold strategy means that everything grows at a much faster rate because all of the money stayed in it. Now, that is if you can. Unfortunately, in the early stages of your development career, you may not be able to, because you may hit borrowing capacity ceilings and things like that. So you may have to turn properties over very, very quickly in the early days, velocity of money, until such point as you can afford to keep a deal. At that point, you want to try and keep everything you can from then on. That's my humble opinion. That's not advice. That's just how I roll, okay? Hoping that helps. Jeff says, thanks, Rob. Andy says, broadly speaking, is it more appropriate approach to purchase property under a company as opposed to a trust if the intention is to sell and not hold? Andy, I can't give advice, and I certainly can't give advice in a public forum. What I can say is that the ATO is going to treat you as an enterprise like a business. Now, if they're going to treat you like a business, you could run it as a business being a company, and there would be no issue or challenge with that. And if your intention is to sell everything, then you have no requirement for capital gains tax. So a company is a very cost-effective way of actually doing that. You could equally do it in a trust. Trust would be a little bit more expensive to set up and a little bit more, I guess, challenges with it. There are pros and cons with each of the entities, and I will cover that as a complete separate session at some point in the future, I guess with the pros and cons as to which one you would do and why. But I guess for all intensive purposes, to answer your direct question, it's very cheap. You're being treated like a business. A company is a business. You have no requirement for the long-term capital gain. A company in that particular circumstance makes a lot of sense. But that's just looking at it from a taxation perspective. You may get slightly different advice with regards to your long-term asset protection advice and whether or not you've got other entities in your portfolio, in which case you may want things to be all tied together, mate. So simplistically, probably but make sure you check that with your accountant. Next one. A lot of people saying great session. Thank you. Helen says many thanks. You're more than welcome. Karen says yes, need to sell fast. I don't know what that's in reference to. I've kind of missed that. Anyway, folks, that appears to be the last of the questions coming through. As always, it is a pleasure coming to you for all of these Sunday sessions. Stay tuned, and I'll be coming to you again next Sunday. If you just happen to bump into this session, the way that you find them is to go and like our Facebook page, Property Developer Network. And then when the time is right, 5 o'clock every Sunday, you'll get a pop-up alert to say I'm alive, or I am live, and just hit the join. So until then, folks, thank you all. And it is bye from me. Bye for now. Bye.